Hey, Dustin Tibbetts, financial advisor here with Jazz Wealth Managers. This is our FinTips series where we just go over something really brief to kind of share, help, or try to teach you if we do in some way today. Maybe you'll hit the subscribe button and help us out, or check us out at Jazz Wealth. We're long-term retirement investment management advisors. Did I say all those words right? Okay, here's the thing. This comes an article from one of our customers, Benjamin. He sent this in to us. That it was a study that was done, and I've got some things to add to this here. From October, November, and December, stock market sold off. If you've been paying attention, you were not excited about that. What the study shows is that the ordinary investor sold off $44 billion worth of mutual funds, not because they were retiring, not because they hit their goal and magically they were done investing, because they were scared. They saw the market sell off, and they sold their positions, right? Now, this research came from the Investment Company Institute. Just so you know, these guys are mutual fund biased, right? So they're very focused on the mutual fund industry. It's not like it was some hedge fund or ETF trying to prove mutual funds wrong. They were showing actual stats. $44 billion that you guys sold off, right? So the question is, look, the S&P bounced 15% from the lows as of this video here. We're almost February now. We're 15% off the lows. We've only got 10% to go before we erase all that decline, right? So the question is the bear market just taking a pause, or is it over? Is that the end of the game, right? Now, we've taught our customers, we have a little area in our website there called the Dojo, where we did videos to show the statistics about what's going to happen with the markets going forward, so they already know. But $44 billion came out of mutual funds. Totally incredible here. This article further refers to, there's a research company called Dalbar. They're based out of Boston. This is what they do. They focus on investor. They focus on sentiment, I believe, a lot when I used to look at them back in the day. They said that the average investor that's invested in an equity mutual fund, just a standard mutual fund focused on the S&P, NASDAQ, tech stocks, whatever it is, equity mutual funds, they lost 2 full percentage points a year, or about 1/4 of the return of that mutual fund, because they sell when things fall, and they buy back thinking, oh shoot, I missed the bottom there, I better buy back in. They never learned their lesson. So $44 billion came out. Now that we've recovered, you didn't buy back cheaper than what you sold for. You now were forced to buy back more expensive than what you bought there. So who gets hurt worse here was the question in their study by Dalbar that said, do the index fund investors get hurt more, or do the actively managed funds, people that invest in those, get hurt more? And let me say this first. We are not active investors here. We do not advocate active investments. We certainly are cool with it. If you want to have your retirement account doing its thing, and then you want to have another account, and you want to be active with it or invest in something active, all great. Don't bet the farm on an active fund, though. So just to be clear, we're not leaning one way or the other. What they found was, from 2002 to 2016, the average investor in a low-cost index fund only earned almost 3% a year. I could sort of vouch for these guys. I did 1,488 phone calls in the year 2018, and towards the end of the year, every call that I got was, Dustin, I'm not a customer of yours, I just need to know if I should sell. Buddy, should I sell my position? I have an index fund, I don't know, should I sell? It's tough when you're trying to actively watch a passive investment, and I get it. It's easy for me to say, look, the markets are going to recover, you're going to be just fine. But for you to live through that, I can certainly understand the emotion of someone who sold during that downturn. The difference is, when I act as your financial advisor, I told all our customers in September, gave them all the heads up about diversifying, get ready, here's what's going to happen and everything. Not to play I told you so, but I told them ahead of time. So the point is, as an advisor, we'll talk you through it. We're not going to let you sell. We're not going to let you panic. A good advisor will give you stats to walk you through. Look, we're not done yet. We are going to go lower, and they'll get you kind of prepared for that, right? So I'm not making the case for active versus passive investments. Actually, they found that the investor in the high-fee, actively managed mutual fund made just over 4%. I'm not 100% on board with that, right? So the exchange-traded fund, the index fund investor, made 2.85%. The active managed funds, people that invested in those, made 4%. To be fair, the active funds underperform on the way up. They do overperform on the way down because they play defense, right? An index fund's just going to say, tough, you invested in the index, it dropped, so did you. An active fund is going to say, we saw the index drop, we adjusted to try to slow things down a little bit. However, when things swing back up, now as they have so quickly, they're underperforming. So there's really, I'm not saying one's better than the other. I am making the case for education. Know what your funds, your stocks, your exchange traded funds are capable of. And I get a little grief for this in the comments below sometimes. Speed and volatility. You want to know how fast that sucker's going to move. If you invest in a mutual fund, how fast does it move? I don't care what the return is. The return will get there. You'll be just fine. But how fast is it going to move, and how much is it going to wiggle around while you're waiting to make your return? So apparently people from at the end of the year here last year saw funds that wiggled around too much just plummet, and they panicked, right? So you need to understand the actual investment that you're in. And you know what? I'm going to do this just off the beaten path here. This is going to be a little bit longer. I'm just going to do this real quick. Hang with me here real quick. Check this out. Did you know what's the average return of the S&P 500 over the life of the S&P 500? The raw return is 9.8%. Is the average return. Do you know that? However, only 6% of the time do you see a return of 5 to 10%. Only 6% of the time in a 90-plus year history. So if you're told the average return in the S&P 500 is 9.8%, but you very rarely see 9.8%, you think you're doing something wrong. You are not doing something wrong. You're doing everything just fine. If you're investing in an index fund, mutual funds, or you've done your own research and kind of gone through that, you're probably doing just fine. But know that 94% of the time, this is not my opinion, this is stat, 94% of the time the S&P 500 will not return anywhere near what the average is. It will not return 5%, 6%, 7%, 8%, 9%, or 10%. It will not, right? Most of the time the returns are on the outsides of those numbers. So understand your investments. Please, please understand your investments. When the markets fall, don't panic, right? I get more customers when the markets fall because they're just scared of something that was working just fine. I tell them, hey, you can stick with what you're doing. And so many people say, no, Dustin, I did something wrong, you do it. As a fiduciary, I say, I'm telling you, you have the right investment. You're fine. Hang in there, sweat it out, you'll be just fine. But yet people go, no, I must be doing something wrong. So understand your investments. Do not panic, right? You'll be just fine. And if there's one thing I could say, understand the stats about where the market is going and about to go. I can't tell you exactly. I can say to customers, I do in our dojo video library, but be very careful and understand your investments. Don't panic, please. So I want to thank Ben for actually sending me the article that I referenced to here with all these studies and everything. Hey, enjoy. We'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.